Hello, and welcome to the sixth episode of our monthly podcast series, Market Matters. Each month, we'll be bringing you big picture insights from leading investment specialists, exploring the opportunities and challenges faced by investors in today's market. Today, I'm joined by Zenah Shuhaiber, Portfolio Manager in the Global Equities team at JPMorgan Asset Management. Zenah is a manager on JPMorgan European Growth Income, which has the ticker JEGI. Zenah obtained an MA in Economics and Management at Oxford University and has been an employee at JPMorgan Asset Management since 2004, having served an internship at JPMorgan Private Bank in 2004. JEGI invests in a portfolio of companies listed in Continental Europe and appeals to both growth and income-oriented investors alike. It aims to provide capital growth and a rising share price over the long term, as well as providing an attractive and predictable income stream. The company pays 4 dividends per financial year, calculated as 4% per annum, based on the net asset value at the close of business on the 31st of March of the preceding financial year. JEGI was awarded an income rating by Kepler Trust Intelligence in 2025, which seeks to reward those trusts that have delivered a high and growing income without sacrificing total returns. JEGI is the top performer in the AIC Europe sector over 1, 3 and 5 years, with a net asset value total return of 89.5% and a share price total return of 95.3% over 5 years, versus its sector peers' average NAV total return of 54% and share price total return of 53.1%. Zenah, thanks for joining us today.
Hi, David. Thank you so much for having me on this podcast. It's really a privilege to be part of this series.
Great. Now let's start with your background first. How did you get into the fund management industry and what attracted you to it?
Yeah, so I grew up in Greece, which didn't have much of a financial sector, let alone a fund management industry at the time. In fact, I grew up as part of a large family where most of my community were architects and engineers. I loved math and economics at school, and that took me to reading economics and management at Oxford University. Once there, I would attend the career fairs and was drawn to the buy side more generally, and was lucky enough to have landed an internship at JP Morgan's private bank. From there, I was offered a full-time job the following year as a graduate within asset management on what is now called our investment specialist team. I spent 2 years learning the team's various investment approaches and products, spending a lot of time with fund managers, crafting their message for their clients. Within that role, there was also scope to attend our investor meetings, sit in on company management meetings, and generally be a part of stock discussions and debates. I love the intellectual rigor behind it, that you could be exposed to so many topics going on around the world and the ability to actually express your view on it. I don't think there are many jobs that you could say that about, so I thought that was quite interesting. And at the time, China was in its mega growth era, and it was fascinating to learn about their property market, the Chinese consumer, and their impact on companies worldwide. So from there, I signaled that I would eventually like to be part of a portfolio management team. And not long after that, an opportunity came up, and the rest is history, basically.
Yeah, so digging into obviously European stocks, which is one of your kind of specialisms. Now it's potentially been a tricky few years for European stocks, with obviously lots of political and geopolitical uncertainties. How do you assess the outlook and opportunities for the region kind of moving forward from today?
Yeah, I mean, it absolutely has been. If you look roughly over the last 10 years, we've had a variety of macro headlines that have come through. So we've had Russia's annexation of Crimea in 2014. We had the Brexit vote here in the UK in 2016. A surge in populism in the far-right countries like France, Germany, Italy, leading to concerns that more countries could potentially follow the UK in terms of exiting the EU. We then had COVID, another Russia-Ukraine conflict, which began 3 years ago. Within that, we've also had countless of, elections in that period too. So it really has felt like there's been a lot going on. But in those 10 years, it's also important to note that the benchmark has gone up 130% in sterling terms. That's about 8.7% annualized and pretty much in line with the previous decade. So yeah, there are worrying headlines around, and the media loves to sensationalize these things. But if you were to wait for that to clear, I think you'd miss out on some healthy returns. What ultimately matters for stocks are the fundamentals of the companies we're investing in and the breadth of that opportunity set available. And I think we're continuing to see some good opportunities across Europe, which I'm sure we'll come on to later on in our discussion.
Yeah, you mentioned the performance of European markets over that time. I guess kind of when you compare Europe to, say, the dynamism of the US market, it's often viewed as kind of a value-oriented market, filled with old economy industrial stocks. Yet JEGI's two largest positions are tech-related in SAP and ASML. How do you kind of assess Europe's tech offering kind of on its own merits versus, rather than, comparing it to the US Silicon Valley?
I think that's fair from a headline perspective. If you look at the top three sectors in the US market, 30% of that is now in technology. And then financials follows that at around 14% and healthcare at 11%. By contrast, the top three sectors in Europe are financials at 22%, followed by industrials at 17% and healthcare at 15%. Technology in a pan-European context is only around 7% of the benchmark. So obviously that's quite small in comparison to the US's 30%. So you could say that the US has a lot of breadth within technology, but for the fewer stocks that we have in Europe, these are actually world-class business leaders. And you've mentioned SAP, ASML, so we can have a look at those. SAP is listed in Germany. It's established itself as a market leader in enterprise application and has demonstrated strong growth, particularly in their cloud business, which is outpacing some of the major US competitors. Their backlog increased 40%. That's a huge number in just 1 year in 2024, and obviously setting a new record high for the company from that perspective. Then you mentioned ASML as well. So this is a Dutch stock within the semiconductor equipment sector. This company operates as a monopoly in EUV lithography machines, which are essential for manufacturing the most advanced semiconductor chips. No other company can produce these machines at the same level of complexity or precision as ASML. And their machines are used by semiconductor manufacturers like TSMC, Samsung Electronics, and Intel, all global companies, to produce the most cutting-edge chips for end markets such as smartphones, AI, data centers. So I think you're right when we look at the sector composition of these two markets. But as European fund managers, I still have some really good companies to choose to invest in should I want exposure to the technology sector.
Yeah, and kind of picking up on ASML and staying on the semiconductor sector specifically. I mean, clearly it's been in the headlines a lot over the last few years. Now, I think it's been viewed as somewhat cyclical in the past. I mean, do you think that perception kind of has to change with the emergence of artificial intelligence, being firmly embedded into the global economy? Obviously, we're seeing a lot of spend from, all companies really in all sectors on artificial intelligence. Yeah, what do you think about that kind of cyclicality argument for semiconductors?
I think that's a really good question. I think ultimately the nature of semiconductor sector is cyclical and will probably remain that way even as it pertains to ASML. So there's two reasons for this. Firstly, chip companies have an inclination to generally overspend when things are going well, and they tend to underspend when things are going poorly. So that creates pretty sort of cyclical inventory cycles. In other words, from ASML's perspective, they'll overorder machinery in the good times, and they'll underorder machines in the bad times. I don't really see this changing, and even with AI, while we're likely to be on an uptrend at the moment, we'll still see these cycles within that capex spend, just as we did with other end markets like smartphones, for instance. Then, from the perspective of ASML as well, specifically, in order to meet that increased demand when things are going well, they'll also be adding capacity. And supply for their equipment would start to catch up. And as this happens, and demand might be slowing, which then leads to their customers' capex declining and ASML seeing fewer orders. So ultimately, it's still subjected to the same cyclicality as other capex sectors, but their monopolistic position does provide them with a smoother ride. So from that perspective, I suppose it could be seen as slightly less cyclical than the broader semiconductor sector as a whole.
And one significant piece of news that we heard last week came as Germany said that it would relax its debt rules to allow it to spend more on defence. This unsurprisingly gave a further boost to European defence stocks. Many have already doubled since the start of the year. Do you have any exposure here within JEGI?
So yeah, that news has definitely had quite a material effect on the sector, as you'd expect. Currently, European countries are spending just under 2% of their GDP on defense, with the market starting to price in that path towards 3%. Some of this will be spent on things like personnel costs, but that mix obviously of purchasing equipment versus personnel will go higher as we get to like 2.5%, 3%, for instance. Now, the good thing for Europe is that European companies are technologically advanced in terms of what they produce. So they would be natural beneficiaries of this increased spending. Over the last few years, we've preferred to own Safran within the aerospace and defense sector more generally because of its market-leading position in providing engines and aftermarket services in narrow-body aircraft, and that's just civilian aircraft. But they do also generate around 20% of their sales from military spend as a European leader in military engines, optronics, and navigation. So that stock is up around 20% year to date, following a doubling of the share price over the last 3 years. So obviously not as much as year to date as the pure defense companies that you would have been referring to, such as Rheinmetall or Leonardo, for instance, but still outperforming the market. In terms of pure defense, we're currently doing some work to assess how these headline news would then affect company fundamentals. But broadly speaking, this could be positive for more than just defense names as well. And there are stocks in our portfolio, such as Heidelberg Materials, for instance, which are benefiting from this theme around kind of reconstruction, infrastructure spend as well. And, in particular, obviously, those stocks that are directly exposed to Germany, but, potentially this is kind of a far-reaching effect throughout Europe as well.
And how much of a headwind would it be if the new US administration follows through with its threats to levy tariffs against the European Union? Or are you kind of less worried about that from a bottom-up perspective?
Yeah, I mean, that it's certainly raised policy uncertainty, and I think that's probably the biggest disadvantage to what's going on from that perspective. On the whole, that 25% tariff would probably impact GDP roughly, call it 75 basis points over 2 years. And that in turn has a sort of 2 to 4% impact on earnings within the region. But we also have to be aware that this isn't a certainty, and neither is the way that Europe reacts. So kind of going back to your previous question in terms of the way Europe reacts, some offsetting fiscal stimulus can obviously offset some of that impact from tariffs. And we kind of know from past history that European leaders tend to be their best and kind of come together in these times of crisis. So we're also seeing comments around deregulation, and as you mentioned, in terms of Germany loosening its budgets, which is quite unprecedented, to support some of the defense spending that we just talked about. And just last week, there was around 1 trillion euros of fiscal stimulus announced, which equates to around 5% of Eurozone GDP. So how do I think about this as a portfolio manager? Well, we can't predict policy. We just don't think that that's necessarily our edge. And how we control for it then is thinking about our entire portfolio and assessing it from a risk perspective. Asking questions such as, from in the case of tariffs, which companies have high exposure to sales in the US? Where is their production based? Because obviously, if it's based in the US, they're not as impacted as if their production was based elsewhere. And do they have pricing power to pass on these additional costs? There is then that knock-on effect on the supply chain for those companies or sectors. And you need to assess where that bargaining power lies within their supply chain as well. So really, we need to think about this holistically. We developed a risk dashboard over 10 years ago that has now served us quite well in managing some of these headline risks over the years, and that includes periods like Brexit, periods like the pandemic, and especially, for instance, coming out of the pandemic. So like when we saw that, the efficacy around Pfizer's vaccine and then following that, AstraZeneca's vaccine. And that really helps in terms of understanding the underlying risks that come through from our bottom-up stock selection.
And which companies, sectors, or countries are you kind of most bullish on within European markets at the moment?
So if I take a step back, it's important to say that, as we talked about before, we're bottom-up investors, and we talk about our positioning in sectors or countries. It's really driven by that bottom-up analysis. And because we're looking to achieve a portfolio that's quite diversified, a core holding for our clients, those overweights and underweights don't tend to be very large. But at the moment, our biggest overweights are in sectors like commercial and professional services, in media, financials, and some of the more consumer-led sectors. Financials, for instance, has been a really strong source of returns for us over the last year or so, within both the banking and insurance sectors. And we spoke about the US market earlier in reference to technology, but I think it's important to say here that, over the last 3 years, European banks have more than doubled, while US banks are only up 30%. So that's a big difference. And obviously, it's not as trendy, it's not as cool. So people don't necessarily focus on that in terms of the differences between sectors. But going back to kind of the sector construction and sector composition of the different benchmarks, that could, become quite meaningful when you think about Europe being at 22%, the financials within that sector composition. So, the other, and obviously what's driving this is their earnings results. So banks have just recorded their 18th consecutive quarter for earnings beats, which again is a marked change ever since the kind of global financial crisis, results that we had seen. UniCredit, for instance, is an Italian bank, and this is one of our biggest actives in the portfolio at the moment. This company has consistently also delivered those strong financial results with improvement on net interest income, with rising rates, strong growth in fee income across kind of various categories. And their operational efficiency has also improved through that cost discipline, streamlining the organization, and investing in growth. And as a result, we've seen meaningful capital distribution to shareholders via dividends and share buybacks. And market participants have rewarded that because they like that certainty. They like that they're kind of receiving something back from the companies.
And where are you kind of most cautious or underweight?
So we're still cautious on the car manufacturers. I mean, I guess, when you talk about tariffs, one of the key sectors that kind of comes into play, it's almost like impossible to say tariffs and not talk about cars or the manufacturers of cars in Europe. But notwithstanding just the news around tariffs for autos, I think this is an area where we've had a lot of pull forward of demand during COVID at a time when companies were quite supply constrained. They're now starting to see more of that supply come online and that supply available. But at the same time, we're kind of at mid-cycle in terms of where we are with volumes in Europe. You couple that with seeing more competitive forces in the market. So a lot of the premium car makers used to generate a decent chunk of their profits from China, for instance. And we believe that has structurally changed with the local companies now providing viable alternatives. And perhaps not just in China, and this is where things start to get a little bit more interesting from a negative point, but they're starting to make inroads into the European market, which is a big change to where we used to be before. It's almost like the tables are starting to turn. Another part of the story that is affecting autos is that slowdown in electrical vehicle penetration, which really just hasn't materialized yet and has resulted in a lot of their plants that were, being utilized, now actually being massively underutilized. So that's where we kind of, we have an underweight to the sector. We obviously still have to pay attention, as we do with all stocks and sectors within our universe, as they do look quite cheap. But we still don't have to see, we still have to wait for that catalyst to see things change from an operational perspective to change that positioning.
Now, right in the intro, I kind of touched on JEGI's enhanced dividend policy. Does this give you more freedom kind of to pick your best ideas rather than tying you to a specific yield target?
Absolutely. I mean, I think it's a great structure. The highest dividend yielding stocks are not necessarily the best investments longer term from a total return perspective. So the lack of constraint really gives us the ability to focus on that bottom up stock selection from a total return perspective, and the portfolio construction to deliver this well balanced portfolio for our clients. So I think it is really important, and it is a great feature for us, but obviously ultimately in the end for our clients and investors.
And looking forward, what do you kind of see as the biggest risks ahead for investors?
So a couple things here. I think one would be the heightened focus on politics. I think they're headline grabbing, and it feels like the more negative they are, the bolder the letters are in a way. Going back to the beginning of our conversation, we spoke about how markets have the ability to see through some of that as they focus on company fundamentals as opposed to kind of politics and macro. And so waiting on the sidelines can be costly. In particular, when you're thinking about Europe. Once you've gotten past that, it's then about the allocation decision. And I think here it's really easy to focus on what has worked well in the past few years, but that doesn't mean it's a good investment going forward. So in the last few years, conversations have been dominated by a handful of stocks, namely the Magnificent Seven in the US or US technology or the US market. And, that has rightly led investors to focus on the US market, where growth prospects have been better than other parts of the world up until now. I think to some extent that allocation has been overextended. And now we're starting to see more signs of life in Europe, in markets outside of the US, in particular in Europe. And I think where valuations are in Europe, when you couple that with some of the catalysts like deregulation or like more fiscal spend, the defense spending that we've just spoken about, that can really power earnings growth going forward. So I think the biggest risk is anchoring on what has worked in the past, as I do think we're going through some underlying changes in the market, which could be more beneficial for European markets.
Joan, you touched on a few kind of positives in that answer. Where do you see as the kind of biggest opportunities for investors moving forward?
So I probably couldn't leave this podcast and couldn't answer this question any other way than to say JPMorgan European Growth and Income, of course. And I'll give you three reasons why I think that's the case. So firstly, there's our unique approach to investing. Secondly, the track record. And third, the dividend policy. So let's get into those. I know that we've touched on some of those in the last sort of 15 to 20 minutes or so. But so firstly, our approach to investing really brings together the best of our fundamental and quantitative teams at JPMorgan. It really allows us to cover that breadth of the market with our quantitative tools, but also to be able to understand the nitty-gritty with the experience of our research analyst team. And putting those two together is really like a great powerhouse and helps us deliver a core portfolio to our investors, which is cheaper than the benchmark and showing better quality and momentum characteristics as well. Secondly, this investment process has been around for a long time, and we've demonstrated our ability to outperform in both the short term as well as the long term. So if you look at our short-term numbers, for instance, I think you mentioned some of those at the very beginning, but outperforming the benchmark by 2% over the 1, 3, and 5-year period, which is a great result. And this has resulted in terms of outperforming in both value and growth markets. So it kind of goes to show that we're not necessarily reliant on one type of market to be able to outperform. And then finally, something that we've just touched on is that consistent 4% yield, which investors get. We think this is an optimal structure that allows us as portfolio managers to choose the best stocks, but also generate a consistent income for our investors.
Now, we hope that gave you a good run through of the risks and opportunities for investors. Zenah, thanks for your time today.
Thank you very much, David. It was a pleasure being on here today.
Now, listeners can find more insights on the KTI website, as well as obviously JPMorgan's, and you can check out JEGI there as well. Thanks for listening today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.